Right. Firstly, a very good morning to you all. Thank you for joining us on our penultimate K3 CPD webinar of 2025. My name's Brian Burke. I'm a Managing Director at Quantuma, which is part of the K3 Capital Group. My focus and my specialism is restructuring. I provide advice and solutions to directors, management teams, owners of underperforming and financially troubled businesses. I work closely with them alongside their professional advisors and try to find solutions that deliver the best possible outcomes. In addition, I work with individuals, those faced with financial issues, creditors, shareholders, and other stakeholders to help protect and preserve their interests. The group offers a wide range of niche advisory services, including restructuring, corporate finance, forensic accounting, R&D tax credits, and marketing services for professional services firms. Just by way of background, the webinar is part of the K3 Hub training and events program. K3 Hub was launched back in 2021 as a member network for professional advisors, and today we have over 3,500 members. Anyway, on to today's session. I'm delighted to welcome back Ros Martin as our speaker. Ros is a regular speaker at our webinars. She advised on tax planning for large and small businesses and individuals, as well as dealing with full and aspect inquiry work. Her clients are mainly small and medium-sized accounting practices. She understands the key issues of concern for accounting professionals, the latest developments in the market, and the practical application of recent legislation. Before I hand over to Ros, just a bit of housekeeping, some simple, straightforward things. Firstly, we're recording today's session. The recording will be available on the K3 Hub and Quantuma websites and should be up and running next week. The Q&A function is open, so do feel free to ask any questions as we go. Our preference is always that you use the Q&A function, but Ros is also happy to take questions in the chat should you wish to drop them there. It's likely we'll have lots of questions today. We may not be able to cover them all during the course of the process, but if we don't get around to answering your question, we'll ask our speaker to respond to you separately via email after the webinar. It's a long session, 3 hours. We'll be taking a comfort break in the middle, probably about 10 to 15 minutes, and obviously make you aware when that's going to happen. We're also running some polls during the event. These are just for fun, completely anonymous, and we encourage you to take part. Always good to get your views and opinions. Before I go, just want to quickly mention that we're running our final CPD session of the year. This will be held on Friday, the 5th of December. We'll be covering year-end tax planning, which is quite appropriate. And if you can join us, please register via the website. So that leaves me to say thanks for your time today. I hope you enjoy the session. Have a great weekend. And Ros, over to you.
Thank you very much, and thank you for that introduction, Brian. Yes, hello, welcome. As Brian said, my name is Ros Martin, and again, just to reiterate, I'm more than happy to take questions, interactions, comments, anything that people have got to say. It always is nice to hear from those people who are attending these sessions, and I will deal with as many questions as I can. And again, if not, we will pick those up afterwards. Okay, so we're going to sort of follow the sort of a number of topics this morning. Of course, the elephant in the room is the budget next week, and we have less than a week now, and the excitement is building. Now, obviously, there is always a risk when you do these webinars close to the budget that something is going to be said next week which totally blows all this out of the water. I think that certainly the rumours that we've had don't suggest that apart from potentially rates of tax going up, that we are going to see big changes in these areas, but obviously we don't know, and so bear that in mind if you are watching this after the budget. Okay, so we're going to start off really with some basic thoughts about ownership structures in relation to commercial property. And I should say, actually, when we're talking about commercial property, I'm not going to be covering, a lot of things to do with residential property, but I think we do have to acknowledge that there are people who do own residential property and run it in a manner which is very akin to a commercial business. So we will be briefly talking about the impact of the abolition of furnished holiday let treatment for tax purposes, and people who are effectively running very commercial type businesses involving residential property. are going to be sort of touched on as we go through this morning. So there's often quite a lot of dissent really about how property should be held. There is a lot of discussion about the fact that having property in a corporate structure is always going to be the best option, and we'll look at that in a bit more detail in a moment. We are going to sort of focus on, some issues, for example, pension funds, and just have a think about that generally. Obviously, the question about a company being the best structure to own property, in some ways, is a hangover from the days when you paid a lot less tax if you had activities within a corporate environment. Obviously now, with corporation tax rates having gone up, dividend tax rates going up, of course, one of the rumours about the budget next week is that dividend tax rates are going to go up. And if dividend tax rates went up, again, there would be, I think, very much a question mark as to whether, from a tax perspective, it is better off holding property in a corporate environment. If you look at the calculations now, depending on the level of profit, it can be very marginal, although, of course, the advantage of having property in a company is that if you don't take the money out, if you are effectively retaining it within the company to be reinvesting into new activities, then it's not really going to be, that there is a tax advantage in doing that. But again, it may well depend, what we are doing. Are we investing purely for investment's sake? Are you holding property as part of a business? What is your sort of longer term planning strategy associated with the business? I think one of the things that's different with, property and property businesses than perhaps trading businesses is that often people are building up a property business with the intention that at some point they will then just sit back and live off the income, pass that on to the next generation, although there are huge IHT issues with that. Whereas with trading businesses, people are sometimes thinking that they're going to build it up and sell it, although again, they may well be passing it on to the next generation. So there are perhaps very different business strategies associated with different ideas. I mean, if you are holding property as an investment, I mean, effectively what we are looking at is really, what option is that we got exactly the same options as we have with with any kind of business. Obviously, with commercial property, there is less of an issue holding it personally because you do not have the interest restriction. So commercial property you do get the ability to fully deduct your mortgage interest if you are borrowing to acquire property. That is one of the drivers which pushes people holding residential property into a company, because you do avoid that interest restriction. Obviously, individuals holding property may be within making tax digital from next year if your turnover is more than 50,000, either on your own, just from your property income, or indeed from property and trading income together. Now, obviously, partnerships do not get mandated into MTD next year. So again, some people are, not wanting to go into a limited company, but are perhaps forming a partnership. Are forming a partnership to avoid making tax digital. But again, we will have to see that. And again, as I've already pointed out, a company may well be more advantageous if you are not going to be extracting funds. So, again, I think once people get to, bigger size businesses, they do tend to use companies. But, again, whether that is cost effective may well be a question. If we are talking about somebody who is holding property as part of a business, then obviously we've got to, thinking about something like their trading premises, then, if you're a sole trader, you are inevitably going to be holding your business premises as part of the, in your own capacity. If you have either a partnership or a company, then, the partnership can hold the property, the company can hold the property, or you can hold it outside. And when you have got partnerships, of course, the other thing that you can do is have it as a partnership asset, but where the capital value is retained by one or more individual. And again, it is often the fact that you have got, it may well be that there is a historical situation, perhaps you've incorporated a business but kept the property outside. There are stamp duty implications on transferring property into companies and so on. And, again, pension fund buying a property can be something. There is, in some situations, the possibility of making in-specie pension contributions, but as we will talk about in a moment, that is not always going to be straightforward. So again, we'll come on to that in a minute. So if you're talking about holding property, what actually might motivate the decision, particularly where you are wanting to keep your property separate from the trade? I mean, obviously, liability issues. If you have a trade which is intrinsically risky, you might want to be thinking about keeping a property separate so that you are not ever going to get to a situation where you are forced to sell a property because you have difficulties in the business. Now, obviously, there are ways of limiting your liability. There are, insurance policies that can be taken out. I mean, obviously, if you have a corporate structure, one of the things you can do is separate properties from the trade by having either a holding company and a subsidiary company with the property, or having a holding company with two subsidiaries, one with the trade and one with your property in it. And that would typically still be a trading group, which means that you wouldn't lose things like your business asset disposal relief. And obviously, one of the things that Brian was talking about at the beginning is that he gets very involved in corporate restructuring. And, this is the kind of thing that sometimes we see with corporate restructuring. Actually, one of the things that I have advised on in the past, and I'm sure that Brian has been involved in, is situations actually where you've got groups that have been established historically, and you decide that you actually want to split the property out from the trading group in its entirety. And there are ways of doing those kind of demergers if you want to achieve that. So, even though it is not necessarily straightforward when you have a pre-established structure, if you are unhappy really with the structure that you've got, it is always worth exploring as to whether or not you can to get to a better position, really. And of course, one of the reasons that you might want to separate the trade from the property is that you will be thinking about retaining the property after you've sold the business itself, perhaps renting it out to your successor as an income stream in your retirement. So again, that can be, and it may well be, of course, that you identify the fact that you want to sell the business, but you've reached a stage where, whilst the business may be saleable, the purchaser actually won't be able to afford to buy the business premises. So again, that is something that might be considered. Now, one of the things that historically we've always said about keeping property outside of either a company or a partnership is that you have an issue with BPR, because if it is a trading business, is there going to be any problem with getting BPR? Though, of course, that all of the planning around BPR is now, thrown up in the air because of the changes that we had last year. If you are holding a property outside of a business, are there issues with charging rent? Actually, we're going to talk about that in a moment. Bearing in mind that if you have a partnership business, any rent that is charged is actually part of the profit share, and so again would be subject to national insurance contributions. If you are a trading business, that can be a bit of a disincentive. Obviously, if you're renting to a company, any rent will be taxable with the ability to deduct interest. So there is the advantage of not paying national insurance contributions, But again, one of the big issues that I sometimes see is in relation to you're renting property to a company, but then you are incurring costs on that property. Make sure that the right person is paying for those costs. Obviously, if you have improvements that are being funded by the company, particularly where there is no formal lease in place, are there tax implications for the individual? Is it actually a benefit in kind, or could the revenue argue that it is a benefit in kind? Is it going to be the case that the company will be compensated for those costs against the capital gains tax liability on any subsequent sale? So before I actually go on to the next slide and talk about that, I'm going to launch my first poll, if that is possible. So we've got an individual who owns a property personally, used by his trading company, decides not to charge rent. Do we have any issues? And please tick for any of those where you might see a problem. One of them I have already alluded to. So if I could just ask you to just tick a box there, and we will just see what we come up with. Okay, so deductibility of costs, HMRC can impose market rent, must have a formal lease, problems where costs are incurred by the company. Yes, all interesting answers. Let's perhaps go with the easier one. HMRC can impose a market rent. Actually, that's not the case. I mean, if you want to let somebody occupy a property without charging rent, that's absolutely fine. And you don't have to have a formal lease in place to support a lack of rent. What I would say actually is that if you did have a formal lease and you didn't charge rent, what HMRC could do is that they couldn't impose market rent, but they could impose a notional premium on the disposal for capital gains purposes. So often, if you are not going to charge rent, you need to be a little bit careful about having a formal lease in place. But you're absolutely right about deductibility of costs. And we've already talked about situations where costs have been incurred by the company, because if you do not charge full rent, then HMRC may argue that costs are not allowable. But actually, what they do as an alternative is say, well, the individual could get expenses up to the level of the rent charge. Now, obviously, if no rent is charged, then that causes problems. And the other thing you have to be careful about is that excess expenses cannot be carried forward and used in later years. Now, obviously, the main one might be interest relief, but certainly repairs and so on, there is potentially a bit of a problem. And as I've already said, when we were talking about the poll results there, if there is a formal lease, there could be capital gains tax issues. And the way that the revenue would attack that is effectively that they would impute this premium. So have to be a little bit careful there. The other problem that we need to be careful about is in relation to capital allowances. And again, I'm going to touch on capital allowances later on. But if you are incurring costs on a building as a tenant, you cannot claim capital allowances on that if you do not have at least a leasehold interest in that property. And in fact, the landlord can't claim capital allowances on costs incurred by the tenant, because they haven't incurred the cost. So there's two legs to the capital allowances provisions. The first is that you've got to incur the costs, and the second is that you've got to own the asset. There is a variation to do with leasing, which again we will touch on later on, but you do need to be a little bit careful in those situations. So certainly down the years I have come across a number of scenarios where effectively you know there have been issues with the revenue in relation to those kind of things in terms of that. You know, that is something that we need to just be a little bit careful about. So what about pension funds? I mean, it can be an effective way of buying things. Obviously, it becomes a little bit problematic if we're talking about getting a property into the company and into the pension fund in the first place. But typically we are talking about either a SIP, a self-invested personal pension plan, or a SAS, a self-administered scheme, and that would be something that we would need to look at. Now, obviously, pensions advice is regulated. As tax advisors, we do not have the authority to deal with independent financial advice. So unless you have got a separate registration with the relevant authority, we need to be a little bit careful, but obviously we can push clients towards getting the advice that they need. So a SIP is basically a fairly flexible product, and one of the classes of assets that you can hold is commercial property. Any contributions may be paid to the SIP either via the individual making personal pension contributions or an employer, and that attracts tax relief for both parties. The SIP itself can borrow up to 50% of the value of the property if they do not have the funds in there to after the event. But obviously there could well be a funding gap if the pension fund is not of significant value. Somebody's just popped a question in: will the slides be sent after the event? They've actually been loaded into the chat, and I think they will be loaded into the chat at various points during the course of this morning for people who've joined slightly later. So there is a PDF, yeah, and in fact the administrator has just uploaded them into the chat again, so hopefully you can download them from there. Obviously, as I've said, with the pension fund there could be a funding gap. The Revenue have got quite strict views about in-specie contributions into pension funds, and you know how that has to be managed, and whether or not, and in fact their view is that in some circumstances there is no tax relief on the contribution of a pension, of an in-specie contribution into a pension. So if you're thinking of making an in-specie contribution, have a look at what the Revenue's guidance is and keep up to date with what the current position is, because it is not straightforward. We've had a couple of tax cases where pensions have properties have been transferred in as in-specie contributions, and the Revenue have denied tax relief for the contribution, because their view is that as a company you only get tax relief on the contribution in cash, and so you have to do a little bit of smoke and mirrors in terms of, you know, what you are actually looking at in order to get tax relief on an in-specie contribution. So just be aware of that fact. A SAS is very similar, but tends to cover a larger pool of employees. So a SIP tends to be taken out for an individual, or potentially an individual and their spouse or their children. A SAS tends to be something that is used for an occupational or workplace pension scheme, that you know can benefit directors, and again can invest in commercial property. Same restrictions on borrowing as you have before. Obviously, if you have a larger pool of potential beneficiaries, then it may well be that you will have more value in the pension fund to be able to fund something like a property. But of course, that will very much depend on what the size of the company is. So there are various types of property which can be invested in. So things like business premises, but also things like hotels, care homes, prisons. Halls of residence do qualify, and indeed a lot of the halls of residence in the big university towns in the UK are actually owned by pension funds. I know that the university where my daughter was, most of the student halls of residence were held by the Unite pension fund, because obviously they have got very deep pockets because of the number of members, but doesn't cover flats or houses let to students. So, again, if there is a residential element such as a shop with a flat over it, then as long as it's not occupied by a member of a pension fund itself, there shouldn't be too much of an issue. But again, you've got to be slightly careful about that. Obviously, any business occupying property as a tenant of a pension fund must pay rent as at a commercial rate, because that is something that the pension fund trustees have got to do. They have got to make sure that they are getting good value for the investments that they've made. So it's perhaps not quite as benign for the underlying business as other options are. So rental income is going to be tax-free for the pension fund, but tax deductible for the business that is paying it, which of course may be connected with it. But that is one of the advantages, is that obviously anything received by the pension fund, any capital appreciation on the property would be tax-free if the property is sold. Or it could be that at the time of writing you would again be able to get a tax-free lump sum, or you might have an income stream available to pay out to fund a pension. So all of those things are do make pensions quite a good point. Someone's asked, a client wants to purchase land, get planning permission and build residential property. At what point does this become a not permitted pension fund investment? I'm not entirely sure of the answer to that question. I would have thought that there might be a possibility that if you are buying the land with the intention or the hoped intention that you would build residential property, that there might be something with it. It's a pension fund question, and I'm not down enough with the detail on those points. I think you'd have to be careful, but I suspect as soon as you would start to build the residential property out, I think that there might be an issue, and you would probably have to get the land out. So I think if that was the intention, I would think you would have to question whether it would be a good idea. But again, I think you'd have to take independent financial advice on that point. So I'm sorry, I can't give you a complete answer there. Obviously, other alternatives, commercial property can be used as an asset class. If you've got an investment portfolio, that is something. I mean, obviously, financially, it may well be not something that somebody would invest in other than as part of, a wider pool. But there are definitely property funds, unit trusts, open-ended investment, and so on. Often not seen as being particularly attractive because, of course, they are highly illiquid when compared with other financial assets. And as it happens, I've been helping a friend of mine complete IHT to do some IHT work for on the estate of their mother, and she held she held a stake in I think it was some kind of investment trust holding property. And, they are basically saying, oh, well, it could take us a year before you can get your money out of this. And so, it's not something that is particularly, seen as being, an attractive proposition. And the other thing that you do get is that sometimes funds do get frozen. So you can't withdraw money. There have been a couple of occasions in recent years where property funds have been frozen because of the nature of the property market. And though, if you are buying into a commercial property fund, which is buying shares in companies that then go on invest in property, they are less likely to have liquidity problems because typically they will be listed shares. And then we have real estate investment trusts, although there aren't that many within the UK, but are potentially seen as relatively good investments. So, again, that, might be something if you're looking at an investment. Again, if you are looking to create an investment portfolio, then you would really need to be taking independent financial advice to make sure that what you're doing makes sense. Okay, another question. A GP partnership owns a surgery property personally through the current partners. The property is not recorded in the partnership accounts. Do the partners need to show the property as a partnership asset for it to qualify for BADR or BPR, or could relief apply even if the property is held outside the accounts? Okay, so BADR, business asset disposal relief, you would only get a business asset disposal relief if the property is outside the partnership, if it is an associated disposal. Which means that somebody selling a share in that property is only going to get BADR if they are effectively selling their partnership share or some of their partnership share at the same time. Having said that, if it was a partnership asset, then you would only get BADR as an individual partner if you were actually selling your stake in the partnership. Basically, that is something that you would need to look at. So the BADR and situation is complicated, both if you've got property outside and property within a partnership. From a BPR perspective, as I have already said, you only get 50% BPR if the property is outside of the partnership. If it was inside the partnership, then you would effectively get 100% BPR because it is a trading partnership and that would attract 100% BPR. Now, obviously, the value then kind of influences it quite significantly because you're only going to get 50% BPR on the value above £1 million. I'd have thought with a GP partnership, it's probably quite unlikely that you're going to be talking about asset values at that sort of level. But again, that is the point. Can you put land into a SIP or a SAS? Yeah, my understanding is, again, I'm not a pensions expert, my understanding is that you can. And somebody has made the comment that one of the main strategic advantages of a SAS over a SIP is that SASs can make secured loans to the sponsoring employer, whereas the SIP cannot. Yes, I mean, I was talking really about property in a pension fund, but you are absolutely right that a SAS is enabled to make loans to the sponsoring employer. Although I was talking to somebody not very long ago who said that in reality, an awful lot of pension fund trustees will probably not may not be willing to lend money unless you can show that it is a good investment for them. So it's one of those situations where there is a theoretical advantage, but whether or not there is a real advantage, it may well be illusory to some extent. Okay, we've talked about furnished holiday lets being abolished and I'm just going to sort of quickly run through, not going to take a great deal of time, but just quickly run through the impact of those changes, so we are, you know, fully aware of this sort of potential, the things we need to be thinking about. So broadly, before the 6th of April this year, 6th of April 2025, legislation's in Finance Act 2025. Before that date, a furnished holiday let business was effectively treated as a trade for income tax and capital gains purposes. So you've got BADR, you've got holdover, you've got rollover, you did have no restriction on your interest relief, etc., etc. So it was seen, as long as you met the minimum requirements, then you were able to effectively treat it as a trade. The one area where it was not automatically treated as a trade was in relation to BPR. So main impact, any interest relief in relation to these properties will only now be given as a tax reducer at 20% rather than as a deduction. And as we saw with when the tax reducer provisions were introduced in 2017 for long-term lets, that could well increase the amount of tax that is going to be paid. Now, obviously, all you can do is do the number crunching and find out whether that is going to be the case. You know, effectively, you know, those calculations are happening. And I have to say that I have had an increase in discussions with people, you know, over recent months again about incorporation of property businesses off the back of that, which was something that we saw, you know, a lot of traffic about in 2017 and after that. You know, but whether or not it does cause an increase in tax is going to depend, obviously, on individual circumstances. Now, losses will be actually able to be offset more creatively or more widely. Since 2011, any loss on a furnished holiday let property or let business has only been able to be offset against profits from that FHL business, whereas now it can be offset against any property income held or generated in the same capacity. And indeed, if you have any unused losses being brought forward at the 6th of April 2025 from your previous furnished holiday let business, it can be offset against any property income in subsequent years. The other advantage of furnished holiday let is that you could claim capital allowances on your disposals and effectively, sorry, on your acquisitions of assets for your furnished holiday let property. Obviously, no new capital allowances going forward. Any expenditure incurred on or after the 6th of April 2025 is not going to be eligible for capital allowances. But if you have any unused pool of capital expenditure from before that date, again, you can continue to claim writing down allowance and offset those amounts against your property, your wider property income. I mean, to an extent, the vast majority of people who have claimed capital allowances have probably claimed 100% annual investment allowance. So it may well be that there are not many situations where you have actually got capital allowances going forward. So that may not be an issue. One thing that I am seeing quite often is that the other thing that you had a carve out for furnished holiday let properties was that you could split the income however you wanted to when you had property owned jointly by spouses or civil partners. Whereas now the default is going to be that your income is split 50-50. If you want to split it other than 50-50, you have to change the underlying beneficial ownership, which you can do using a trust deed. And then you have to fill in a Form 17 and submit it to the revenue. You can't backdate a Form 17, and they must be submitted to HMRC within 60 days of signing. So if you haven't done this yet, you are going to have a problem, because you're going to have a potential issue in 25-26, because you will have to split at least a proportion of the income since the 6th of April 50/50 up until the point at which the Form 17 is valid. So again, I have come across that once or twice. So as I've said, disposals will no longer qualify for business asset disposal relief, holdover relief, rollover relief. There is a transitional provision, which means that if your furnished holiday let business actually ceased before the 6th of April 25, you have actually got 3 years from the date of cessation to sell your assets and still claim BADR in it, though of course the BADR rates have now gone up to 14% and will go up to 18% from next April. But again, it has to have actually ceased. If you didn't cease your business, then you are, just because furnished holiday let treatment has been abolished, is not going to be cessation for these purposes. So you need to be a little bit careful. Now, is there any argument for trading? So at this point, I'm going to ask if we can have our second poll, please. So can a furnished holiday let business under the new regime ever be treated as a trade? And actually, with any of these questions, perhaps what I should say is that if you do have any additional comments to make on these questions, please do either pop them into the chat or the Q&A box as we go through. We're only going to have about 4 or 5 of these polls as we go through, so there's not a huge amount to talk about here. Okay, so 50%, half of the people exactly, said yes, you can treat a furnished holiday let business as a trade. 24% said no, 16% said partially, and 10% said don't know. And somebody said, wasn't the whole point of abolishing them to avoid the trade definition of these? Well, actually, that's a good point. But there has been, before furnished holiday let treatment was abolished, of course, people didn't need to argue that they were trades because actually they got the trading treatment that they needed. Now, interestingly, if you look at the revenues guidance, their view is that the element of the income relating to the property itself is never going to be a trade. They do acknowledge that in some cases, the services that you are providing would be a separate trade, but my own personal feeling is that is, almost impossible to prove in practice. This is the example that's in the revenues manuals, and it talks about somebody's got 5 furnished flats. This is about furnished flats rather than furnished holiday let property, but I'll come on to that in a minute. Annual rent, but then she makes a separate charge to cover gas, electric, hot water, central heating, provision of linen and laundry facilities, weekly cleaning, 24-hour reception and porter facilities, and maintenance of all machinery provided in each flat. So the revenues say that service charge that she gets is a trading income stream, but the rest of it is always going to be rental. So I think the problem that you've got in relation to something like furnished holiday lets, in that scenario, the one that is envisaged in the revenues guidance, it's pretty clear that you have got a separate charge for the services that you are providing. But ultimately, if you've got something like furnished holiday let property, you are going to be charging a fixed amount. If you go on something like Airbnb, apart from the cleaning fee, which has always struck me as being astronomical in a lot of cases, there isn't any sort of facility to separately charge for the services that you're providing. And what the revenue due very clearly says is that you can't say, well, this is short-term rental, the rent is higher because I'm providing services, because the revenue will argue that, rent for a short term is intrinsically going to be higher because of the lack of certainty of occupation. So I think even though there was quite a lot talked about in relation to, well, we'll just say that this is a trade, I think that it's going to be something that is going to be you're going to get pushback from HMRC on that, and I think again, wasn't the comment that's made wasn't the whole point of abolishing these to avoid the trade definition. Yes, it would make no sense whatsoever to abolish furnished holiday let treatment, and then effectively allow it to be treated as a trade. And someone said Airbnb rents as a trade. I don't see any really possible argument for arguing that Airbnb is a trading. I mean, I'm sure that there will be people who will try it. I'm sure that there will be people who will try it. But the point is that the definition of a property business is where you are getting income from land. And the vast bulk of what you are getting, even in something like an Airbnb, is going to be about the actual property, the rental. And the point is, I suppose, what advantage do you get if you can say, okay, this is the amount that we're getting for rent, this is the amount that we are getting for our services? Because if you borrowed money to buy your property, that is going to attach to the rental bit of the property, so you are still going to get your residential interest restriction. So you're not going to be able to allocate a lot of costs, obviously, other than perhaps the person who's doing the cleaning or something like that, but then you could deduct that against the property section of it as well. So I can't particularly see that splitting it is going to give you many advantages. And, even if you've got a lot of short-term rentals, I can't see that that is ever going to be trade. But as I say, I'm sure that we are going to have a challenge on this. I'm sure that we are going to get some kickback on it. But I don't see that it's something that is going to be easy to argue in any way, shape or form. Okay, let's very quickly just have a look. For VAT purposes, income from Airbnb is construed as fully taxable income. Yeah, I mean, I know that, and it's just one of those inconsistencies that we've got, that effectively you have got it is definitely a business, and it's just that is the different definition that we have got from for VAT and for direct tax purposes. And as I say, I am absolutely certain that we are going to see people making challenges to this and reporting their income from Airbnb and other similar type activities as trading. But the point I'm trying to make is that I think that there is going to be pushback from the revenue, although I am in no way suggesting that just because there might be pushback from the revenue that we shouldn't do something, because that's not really the way that I would operate. But I do think that you would, I suppose the point I'm trying to make in reality is that you have got to accept, I think, that those that the revenue would ever accept as a trade are very much going to be the exception rather than the rule. So again, I think we can take that as we want to, really. Okay, let's talk quite briefly about CIS and VAT, but always the point. So CIS, as we all know, CIS is a mandatory scheme, so that if you are within the construction industry, then you have got certain compliance obligations. So effectively, to be caught by CIS, you have got to have a contractor, you have got to have subcontractors, and you have got to have a construction contract. Now, CIS was introduced way back in the 70s, a long time ago, even before I was in tax, to attack or to try and mitigate cash within the construction industry. In those days, it was purely a cash trade. A lot of people fell under the radar, and that's why it was introduced. Now, the key issue here, as I said, is we've got to have a contractor, we've got to have a subcontractor, and we've got to have a construction operations. And a contractor is somebody who is carrying on business which includes construction operations, and they are defined as mainstream contractors. Now, HMRC's view is that it is very unlikely in most situations that property investment businesses are going to be mainstream contractors. And the argument is that that is because what they are looking for is someone who is effectively getting economic value from construction operations. So someone who is just undertaking normal repair work, even if it's on a fairly large property portfolio, they are getting the economic value from actually renting that property out. However, they do also acknowledge that if you had somebody who was regularly incurring very significant work on property that they own, so for example, somebody who had a business model where they were buying rundown properties, renovating them to rent out, because then, and again, I don't think that if you just did that once that you would be caught, but if somebody has got a business model, and you know, I've got one of my clients is broadly does that. I mean, he won't buy something unless it's A, gets it very cheap, and B, it's almost falling down. But you know, and he very occasionally does them up for sale. But broadly, he's doing that to you know, to effectively build up an investment portfolio. So if you have got clients who are regularly doing significant work, then obviously that needs to be reviewed. Someone who has very large amounts of construction can be a deemed contractor, but, and I think that could apply to very large property landlords, but I suspect that it's unlikely to be within that category. There's not very many people who are going to have so many properties that they're going to incur that amount of money on repair work. So I don't think there would be many that would fall within the deemed contractor type category. So it's something to keep an eye on. Now, obviously, you know, it doesn't mean to say that work done on, you know, someone's property is not going to be within CIS, but it just means that the landlord is not going to be subject to CIS. So HMRC have recently changed their view on a particular situation, and that is where a tenant is carrying out work which would be the landlord's responsibility in exchange for a financial contribution from the landlord. And HMRC always considered this basically fell within CIS, that the tenant was the subcontractor and the landlord was the contractor, although that wouldn't be caught if it's basically being covered by a rent-free period, or if the landlord makes a capital contribution where actually the tenant does not have an obligation to complete the work. Although I can't see that, you know, that is going to be, you know, something that you would see very often. But there was a change in legislation in 2024, which basically removes doubt from these. and effectively is going to mean that there should be less uncertainty, about whether these kind of situations apply. Where you are making a payment in relation to a lease, or which is enforceable under the terms of the lease, where you either do the work, the tenant does the work directly, or they specifically contract with a subcontractor to carry out the work, and where the work is primarily for the benefit of the tenant. The only area where there might be a problem with that would be where the work is being done on the common areas in a building. Again, we've got to be a little bit careful in relation to this. So talking about VAT, again, one of the issues that we've had over the last few years is the reverse charge for the construction industry scheme. And again, this was supposed to be, again, because the revenue believed that there was a lot of non-compliance within the construction industry as far as VAT goes. So this applies where you have got both a subcontractor and a main contractor who are VAT registered, where the work is within the scope of CIS, and where there is a VAT element to the work, so wouldn't cover zero rated work, and we'll come on to that in a minute. And effectively what you do is you have a reverse charge applies, and the main contractor has got to be basically receiving those services and making those services onwards to an end user. Again, if we had somebody who is having an extension built on their house, that domestic customer would be the end user. The main contractor, if they subcontract work out, would fall within this provision. And the reverse charge also applies to materials being supplied. And so again, what effectively happens is that you don't have the subcontractor, you don't have the subcontractor charging VAT on their invoice to the contractor. The contractor effectively records it as both output and input tax on their VAT return to zero out the position. Effectively, issues that a subcontractor would need to think about, obviously they should know whether they're VAT registered. They need to check to see if the main contractor is VAT registered, and don't forget that it is possible to verify a registration number online. You would need to know that the main contractor is registered for CIS, obviously, and is the work within the scope of CIS, and basically is the main contractor passing the supply on to an end user. And HMRC basically suggested at the time that this was introduced, I don't know how widely this is used in practice, suggests that you have a contract, basically, which means that the subcontractor says they will charge VAT unless the customer informs them. So the contractor informs them that they will be recharging the services to an end user. Now, again, we're not always going to see these kind of transactions under the terms of a contract. Actually, that's not what the law says. The law actually says that the reverse charge should apply automatically unless the subcontractor is notified that the main contractor is an end user. If you answer yes to all of those questions, the subcontractor would not charge VAT on the invoice. They put customer to apply reverse charge or similar wording onto the invoice, and they don't have to charge VAT. If the answer to the question is no, then obviously you would charge VAT as usual, and there is potential, of course, for there to be cash flow issues for the subcontractor, but particularly where they have incurred costs on materials. For the main contractor, obviously they need to know whether the subcontractor has charged them VAT. If the scope, actually, if the supply is within the reverse charge regime, then the proper technical position is that VAT has been charged incorrectly and you can't claim a deduction for it. So what the contractor should be doing is challenging that and paying the net amount only. If no VAT has been charged and the subcontractor is VAT registered, then that's absolutely fine. And then you need to consider so if it's within the scope of the reverse charge, or is it just a zero rated invoice? And obviously it's important to make sure that it's recorded correctly in the accounting system. And for the contractor, effectively you put both the output and the input VAT on the tax return, and purchase value in box 7, nothing in box 6, which is different from where you have international reverse charge services, where you have to put the value of the sales in box 6. Basically, an end user is someone who will not themselves be supplying services on. Could be, for example, if you're doing work where the contractor is not supplying, doesn't have an end client, perhaps on the contractor's own properties. And again, we come back to the question about whether a property developer is an end user, and that will actually come back to the question of whether or not they are within CIS. Again, that cannot be, it's not always straightforward. I always think that VAT on property generally is, a bit of a dark art. It always strikes me as being hugely complicated. So we effectively have 3 rates of VAT. We have zero rated transactions. We have reduced rate transactions where there is a 5% rate of VAT. And then we have standard rated transactions. Effectively, you have got dwellings, residential, buildings for a residential purpose, and buildings for charitable use will be zero rated where they are being built, or effectively on the first grant of a major interest in that by the person building it. Reduced rate, conversion of non-residential to residential, change in the number of dwellings or renovation of dwellings that have been empty for more than 2 years. Standard rated, where you have got commercial within 3 years of completed or part completed, or commercial when where the supplier has opted to tax. Now, other property will then be exempt from tax. And obviously the point about transactions which are exempt from tax is that effectively you are going to not be able to claim a deduction for your input tax. Kind of things that you would see where you are going to be standard rated. And this is where we get the inconsistency between VAT and direct tax. Sale of buildings, extending, enlarging, converting, renovating, refurbishing, repairing buildings, things like vehicle parking facilities, renting out holiday accommodation, and that's because of specific legislation, tent pitches and rental, holiday caravan pitches and rental, And so one of the questions we've asked is that, is an Airbnb business subject to VAT registration? Well, if it breaches the VAT registration threshold, and of course, one of the rumours that we've had is that the VAT registration threshold is going to drop materially. And of course, that could affect more furnished holiday let businesses. Basically, you have got to think about those particular provisions. So sorry, moving on, lost my train of thought. If you want to opt to tax in relation to commercial property, you have to make a decision to opt to tax, and then you have to notify the revenue, typically within 30 days. The revenue do accept late notifications. If there has been an error in charging VAT on a property where no option has been made, it's likely that you are not going to get retrospective permission to do that. If the director or owner deliberately decided to charge VAT, you can potentially backdate that, but it is not, it's not always straightforward. Certain situations where HMRC is required to grant permission, and there are various situations where opting to tax will be granted automatically. But it's very long-winded, and I'm not going to go through those here. It's not surprisingly, it's broadly designed to counter avoidance arrangements. And don't forget that opting to tax is basically made on a building by building basis. It's unique to the person making it, doesn't subsequently bind owners, and there are various issues about, when we're talking about building by building, whether it's a single building, whether it's linked, what about other buildings within the curtilage, it will also then apply if you subsequently extend the building. Again, it is not straightforward, but there is quite a lot of information that is available. Okay, a few questions. Would costs incurred pre-planning permission fall into the reverse charge of VAT? I would have thought it would be unlikely. I'm just trying to think of a situation where you might end up with, because most professional costs are outside of the scope of that. So if you're talking about things like, I wanted to say artichokes then, I meant architects. No idea why that word popped into my head. I would think that most of it is going to fall outside of CIS. And if you go back to that slide where we were looking at the conditions, it's got to be work within the scope of CIS where both the contractor and subcontractor are registered. So I would thought that it's most likely going to be professional fees. I suppose you could have preliminary work on the land. If it's within CIS, then I suppose that might be the case. I don't know how many people actually do work before planning permission has been obtained. I suppose you could, perhaps on bigger developments. Opt to tax, a farm has multiple outbuildings and the farmer wants some opted to tax and others not. Is this possible? Again, really interesting question, which probably can't really answer, because we are looking then at whether or not you have got buildings that are within the curtilage of a main building. I mean, I would have thought with multiple outbuildings there should be the possibility that they are separate enough that they would be separate buildings, and therefore it would be possible to have a separate opt to tax. But I think it would very much depend on the sort of the layout and the the exactly what was there and how far apart the buildings were, and whether there is any links between them, and so on. So sorry to be a little bit vague there, but I think that is one of the questions where it is a theoretical possibility, but you would have to have a look at the actual layout and configuration. Basically, it is just one of those things. So yeah, I think we will just have to, you just have to look at it on a case-by-case basis. Right. Okay, let's move on and talk now about leases. So I suppose because we are focusing more on commercial property rather than residential, we are going to see issues with leases more often. And so, we are going to, it's certainly something that I deal with quite a lot with my clients. So just, looking at the terminology, and I'm sure everybody understands this, but typically we've got two legal estates in land, being freehold and leasehold. And a leasehold interest is going to be one where you have got occupation, normally for an absolute term. Somebody might have the right of occupation for life. We don't tend to see that in commercial property, but that's still an absolute term. And exclusive possession is given by a proper leasehold interest. And you can have tiers of leasehold interests, as long as each superior interest is longer than the inferior interest. Then you can have successive leaseholds. It's not quite so bad with commercial property, because you don't tend to see subleasing, but some of the properties, particularly in central London, have just got so many leases associated with them, different reversionary interests. And about 10 years ago, I was asked to advise on the SDLT implications of a leasehold enfranchisement on a house in Marylebone in London, which had been divided up into, I think, 5 flats. And there was something like 17 leases on the property of differing lengths and differing complexities. And it was an absolute nightmare. From a tax perspective, and then this is kind of tax linked, a long lease is a lease that is more than 50 years, whereas a short lease is one that is 50 years or less. So a 50-year lease would actually be a short lease. A long lease is anything, more than that. We've already talked about multiple leasehold interests. And just again, terminology, when somebody grants a lease, that's when they create a new lease. When a lease is assigned, that is when you effectively sell the existing land interest. So how long is a lease? May feel like a very straightforward question, but actually the length of a lease is different depending on different taxes, although for income tax and capital gains tax it is sort of aligned. Where a lease is unlikely to continue beyond a particular date, and any premium that you might pay is aligned with that, then it would end on that particular date. Although obviously if you just pay market rent, you're not going to have that kind of flexibility. If the lease can be extended, you have to take account of whether or not it is likely that that lease will be extended. And again, similarly, if your tenant may become entitled to take out a further lease, you've got to take account of, whether or not that is likely to happen or not. For stamp taxes purposes, and I know that the slide says SDLT, but we also mean LBTT and LTT as well. Break clauses and rights to renew are ignored. So you do effectively just look at the length of the lease as it is outlined in the tenancy, in the lease agreement. It obviously, from a stamp taxes perspective, the length of the lease can be very important. And we're going to look at a lovely example of the complexities of SDLT on leases after the coffee break. Oh gosh, the big question come in. I will look at that's to do with that. I will have a look at that in the coffee break, if you don't mind. So assignment of a lease is effectively where the lease is just sold to another party. All of the terms of the lease remain under the existing lease, and somebody else simply rents the property. So it's almost like you cross out one name in the lease and you put another one in. If it is a long lease, then any gain is calculated in the normal way. So whatever you sell it for, less whatever its cost. And I suppose that kind of alludes to the fact that with long leases, we are much more likely to have a situation where a premium has been paid rather than it just being a rental type situation. With a market rent lease that is assigned for no cost, there would typically be no gain. So if somebody is paying market rent under a lease, then there is no capital value to that lease, because effectively the tenant is paying the landlord through the market rent. So there wouldn't be any gain arising, although again, as we were talking about before, one of the things you've always got to check with is that it really is market rent, because if it is a connected party transaction, then they would the revenue could impute a premium if the lease is not at market rent. If you have a short lease and it's 50 years or less, then it is a capital disposal. But one of the issues is that you do not necessarily get a full deduction for whatever premium you have paid to take that lease out, because when you have a short lease, there is an intrinsic view that that the lease is wasting away, and therefore that in many circumstances the cost that you are paying is going to be lost. The wasting tables are in Schedule 8 of TCJA 1992, and they're not straight line, they accelerate. So it's a kind of a U curve. It's not a bell curve, is it? Well, anyway, it's a kind of a curve that goes like that. So basically, you take the percentage at the particular date of purchase and percentage at the date of sale. You divide that by the percentage at the date of purchase, and then that is multiplied by the original base cost to give you the allowable deduction. If you've obviously incurred any, if there is any income tax element, then you also have to reduce that if you have had somebody claim a deduction for it. So just to give an example, I mean, most people learn how to do this when they're doing their exams and then never ever think about it again. A lease was taken out for a premium of 50,000, 25 years to run. It's assigned when there's 13 years to run for a premium of £40,000. So the percentage applying to a 25-year lease, 81.1%. The percentage applying to a 13-year lease is 56.167. And so the actual expenditure was 50,000, but we exclude the amount relating to that formula. So the base cost will be 34,628. So they're getting 40,000 premium. So the gain is going to be 5,371. If the original lessee has claimed income tax relief on any amount of the original premium, and we will see when that might come up, then you exclude that from the premium, that the actual expenditure at the beginning before you apply the formula to restrict. So again, it's just a method of calculation. Granting lease may be a market rent lease where you're just going to get rent, income tax on the landlord as it arises, deductible for the tenant. If a premium is paid, then basically we allocate the base cost of the freehold using the A over A plus B formula. A is the premium, B is the value of the reversionary interest. And if you have got a lease of less than 50 years, or 50 years or less, actually, it should say, then an element of the premium is chargeable immediately to income tax. And that is the formula that you would use. And then when you work out the capital gain, it's small a divided by big A plus B. A is the capital element of the premium, A is the total premium, B is the value of the reversionary interest. And we will see in a minute that the rules are different if you're granting out of a short lease. And if there is an income tax charge, as we know, as we've already alluded to, the income element can be spread over the life of the lease as a deduction for the tenant if they are trading. What are the tax implications of granting a long lease for a residential flat to a subsidiary company at no charge? One of the great things about any transaction involving groups of companies, of course, is that there is a relief from capital gains tax if you are members of a capital gains tax group. So as long as the subsidiary is at least a 75% subsidiary of the parent, even though theoretically a granting of a long lease to a subsidiary company at no charge would have a capital gains charge associating with it, because it is a connected party transaction for no consideration, and you would impute a market value premium. Any capital gain which arises is covered by the intra-group transactions, and therefore there would be no capital gains tax liability arising. Obviously then subject to degrouping charges, such that if the subsidiary company left the group at any point in the 6 years following the transaction, there is the possibility that the capital gains would crystallize. There is also an SDLT group relief. So even though it is again a connected party transaction for stamp taxes purposes, group relief would be available, but also a degrouping problem. But the degrouping window for SDLT or other stamp taxes is 3 years rather than 6 years. So I think one of the problems that we have in relation to use of subsidiaries in that way is that if you remember when we were looking at the VAT, the first grant of a major interest in residential property is 0 rated, and so sometimes if you have been recovering costs on the basis that you are going to make a 0 rated supply of a residential property, which then cannot be sold, or you decide that you are going to keep that for renting out, you need to make that first supply so that you are able to kind of confirm the zero rating of the transaction. But then if you went on to subsequently sell the company, you'd get the degrouping charges if you're not careful. Although in that situation, if you then did find a buyer for the property, I would imagine that there's a good chance that you'd be selling the property, although not inevitable. So there can be complications when we look at the interaction between the transactions. As we've already said, if you grant a lease at less than market value between connected parties, HMRC can impute a premium. I suppose the one point to note is that you don't get any of the imputed premium subject to income tax, and effectively that is going to be problematic, and HMRC can only charge that if there is a formal lease. Granting a short lease from a short lease, you take the premium, you deduct the apportioned cost using the formula S minus X over Y, where S is the percentage when the head lease when the sublease was granted. X is the percentage for the head lease when the sublease ends, and Y is the percentage when the head lease originally granted. To be honest with you, as I say, most people learn about this when they're doing their exams and they never think about it again. I can never remember what the formula is. I can never remember how you work it out. And so I always just look at the legislation or look at my notes. And, you know, effectively there is a mechanism and you've got to then look at it. Let me just have a look at this example before we go for a coffee break. Husband and wife own their own large home. They formed a company and are commencing an upscale B&B business through the company. All the costs have been paid by the company in relation to fitting out the bedrooms and areas for B&B, and this has taken 4 years. They are not charging any rent to the company. Will the cost be allowable in the company, and what are the VAT issues for the company in relation to pre-trading expenditure if they register now? Well, the VAT issues are exactly the same as in relation to any pre-trading expenditure, in that you can claim expenditure incurred before you start trading, but there is a time limit on it. And I seem to remember it is 7 years for goods and 3 years for services. I can't remember, but anyway, I might actually, for VAT purposes, it might be less than that, but it would follow the normal rules. Will the cost be allowable in the company? I mean, again, really difficult one. If they do not have a formal interest in the property, and I'm assuming that these are assets on which capital allowances would be due rather than costs relating. I mean, if they're costs relating to the business and they are revenue costs, then I would imagine you are going to be able to argue that they are holding exclusively for the purposes of the business. Anything where you are wanting to claim capital allowances, going back to the point I made earlier, I think you might have issues because you haven't got a formal interest in the property. So yeah, there may be a problem there. Anyway, it is now 10:30 and I did say that we were going to have a break. So I think we will have probably just under a quarter of an hour. So I will come back online around 10:45. Hopefully that will give you time to have a comfort break, make yourself a cup of coffee and so on. If you do have any questions occur to you while you are having that comfort break, please pop them into the chat box and I will deal with them when I come back. Okay, let's carry on thinking about leases. So one of the things I think which is quite interesting from just a general perspective, and one I get asked quite a lot of questions about is, sort of inducements type situations. Now, obviously not, everybody who takes out a lease is going to get an inducement, but certainly there are occasions, particularly with commercial property, where that happens. Now, you do have to be careful, because in certain situations that is going to be what is called a reverse premium, which will mean that it will be taxable on the tenant as income. And basically it would be a receipt of either a trading business or a property business, depending on what they're actually using the property for. But the problem is that there is a mismatch, because the landlord does not get a deduction for any inducement it pays to a tenant to become a tenant, because whilst it is a capital enhancement cost, they're only going to get a deduction for it if they sell that property whilst the tenant is still in occupation, and so they don't get the immediate benefit from it, whereas the tenant will be taxed on it typically. They might get a deduction if they were actually a property developer, so if they built it as and it's going to be trading, but typically that is not the case. The legislation specifically catches situations where the landlord makes a contribution to fitting out costs, or where they either assume the liabilities or pay sums to third parties. So if, for example, they said, you've got a business that's got a pre-existing tenancy agreement in a building, they say, well, you come to our new shiny building, and what we'll do is we'll carry on paying the rent on your old building until the end of the term. Now, obviously, whether or not that's cost effective will depend on how long it is until the previous, but in terms of timing, that might be a better deal for them. So all of those things could be caught as a reverse premium. But one thing it doesn't catch is rent-free periods, and so in reality, that is what we see most often. Now, the tenant does have a tax impact of a reverse premium, of a rent-free period, of course, because they're not going to be paying rent, and so they're not going to be getting a deduction for it. But they don't get that upfront tax charge relating to the reverse premium. So I think that is probably seen as being better. So we've talked about grants of leases. So what about assignments? This is where, again, we've, I think we've covered all this already, actually. Yeah, we've covered all that already. So let's move on to, don't mind, there's obviously duplication there in the slides. So surrender of a lease. A lease is surrendered when it is effectively just transferred back to the holder of the immediate superior interest. So effectively, there is a merging of interests, disposal by the tenant, acquisition by the landlord, and again, basic provisions as if it's been sold to any other person. If the landlord pays, then that will be a capital receipt for the tenant. You will look at any residual expenditure they've got to find any capital gain. The landlord might get a deduction if he sells the property whilst it's empty, because it will be enhancement expenditure. But again, it's one of those situations where actually you've got to be very careful, because if they're getting rid of the existing tenant so that they can get a new, nicer, better, shinier tenant, then actually the expenditure on getting that first tenant out is not going to be reflected in the nature of the asset when it is disposed of, and therefore you've got a bit of a problem. You would, again, not going to get tax relief on that at all. So if a sum is paid by the tenant, it will be a capital cost for the tenant, which is not an allowable deduction. It will be taxable on the landlord, at the very least, as a capital sum deriving from an asset. So again, it is not very effective. So what we often see in these situations is that the payment is sort of badged in a way that gives a chance of the tenant getting a deduction for any payment they made to give up the lease. And one of the things that is sometimes looked at is structuring any payment to the landlord as a dilapidation cost, because most commercial leases will have a clause which require the tenant to keep the property maintained, and for a tenant that expenditure would normally be revenue in nature and they would get a deduction for it. And so the argument is that if they haven't really been claiming, they haven't really been doing the work, dilapidations expenditure accumulates, and so they make a payment to the landlord in lieu of the costs, and because the cost would also be revenue in nature, that payment in lieu is deductible as well. The landlord would still be taxed on the receipt, but obviously would then be able to claim a deduction for any work that they actually did. And so that's why we often see dilapidation clauses where a tenant is actually making a payment to get out of the lease. You have to be very careful because, and in particular, if the tenant has actually been keeping the property repaired and maintained, such that really the only thing that has accumulated in terms of the dilapidation cost is what has been generated in a relatively short space of time, then HMRC are clearly not going to accept a whacking great payment when the lease comes to an end. So, you know, again, you do have to be very careful with that. Now, SDLT and leases. Normally, when we are looking at leases for stamp tax purposes, and I say SDLT, but largely, apart from the percentages, the figures, the same will apply in Scotland and Wales if we have LBTT or LTT. But this was a case, and normally where you've got a lease being taken out, you calculate a figure for the rent, which is called the net present value. You pay SDLT on the net present value at a rate of 1 or 2%, so fairly low. You will also pay SDLT on the premium at the normal ad valorem rate. So, you know, if you're talking about commercial, 2% or 5%. So you work these figures out when the lease is taken out, you pay over the SDLT, it's all well and good. But I had this case recently where I really had to dig through. I mean, SDLT is one of the areas where I do give a lot of advice. So I do kind of know what I'm talking about, I hope. But what we had was a client who had two companies, one trading company and then one owning property from which the other company traded. And the actual property company had two properties bought at different times. For the first one, they'd had a formal lease in place for a number of years, but no lease on the second property. The first lease had expired and they were what is called holding over, which is where the tenant remains in occupation after the end of a lease. And what had happened was that a new lease had been drawn up in 2017. They'd gone backwards and forwards, but it had never been signed. And so the question that I was asked by the accountant was, well, what's the SDLT analysis if we sign those leases now? What would the SDLT analysis be if we put a new lease in place? So I'm going to ask for the next poll to be brought up now, and I'm going to ask you that question. What would your initial thoughts be about the SDLT analysis of this? Would we be calculating the net present value from the date the lease was signed? Would we be looking at difference in treatment between the two leases because of the previous lease? Is there no SDLT because they're connected parties, or have you got another view? And if you have got another strong view, you don't forget, you could always put it in the chat or in the Q&A. But what is your thought about what the tax position is there in relation to those leases? Okay, so over 50% of you say that you would calculate the net present value from the date that the lease is signed. Just over a quarter said no difference in treatment between, there is a difference in treatment between the two leases. 16% no SDLT as connected parties, and then 4% another view, although nobody's popped anything into the chat box. Yeah, interesting. Now, the actual answer to the question is that there is different treatment between the two leases because of the fact that one of them has been currently held over and the other one there was no previous lease. Now, they are connected parties, but they're not a group company. They're not grouped companies. Perhaps I should have made that clearer on the example. They were two standalone companies. And so for SDLT purposes, you would have to apply stamp taxes at market value because they are connected companies. So, okay. So the easier one is the situation where there is no previous lease. Now, the way that the legislation works is that if you have a lease which has a particular start date, but it's not actually signed until some point later, you do only calculate the net present value from the date that it is signed. That is correct. But the rent that you've actually paid from the date of commencement to the date it is actually signed is treated as a premium. Now, in this particular case, the position that gave us was that the SDLT liability, if we did that, if we just took the original lease, which was supposed to be being signed way back in 2017, quite a lot of rent has been paid since then. If we did that, the SDLT liability would have been £49,500. So that's quite a big figure. What I worked out is that if we put a new lease in place now, so we got rid of the old lease, a 3-year lease based on the rent that they were wanting to pay, the SDLT cost would have been 2,702. For a 5-year lease, it would have been 5,272. So in that case, it's a pretty straightforward decision to be made from a tax perspective. And actually, it doesn't affect anything that's happened before. Rent has been paid, it's been taxed in the one company, it's been deductible in the other. There was no formal lease in place. Because there's no formal lease in place, there is no stamp duty. And, you know, as we've already said, we don't have to have a formal lease in place. There are problems in doing that if you don't have a formal lease in place, but there is not, in absolute terms, a problem with that. So that was fairly straightforward. Now, when we have leases being held over, we have a really weird, well, I always thought it was weird, analysis from a stamp taxes perspective. So when the lease finishes, you are treated as if you are taking out an old lease, which is a new lease, which is the old lease plus a year. So if you had a 5-year lease originally, as soon as that lease ends and you remain in occupation, it's a 6-year lease. And then at the end of the first 12-month period, it becomes a 7-year lease, and then an 8-year, and so on and so forth. So you get to the stage where you're actually holding over, where your SDLT returns would be being made on an annual basis. So in this case, the previous lease ended in 2017. So at this point, because of the holding over provisions, we've actually got 8 SDLT returns outstanding. And what you do is you work out the net present value on the full amount of rent paid over the whole period, and then you get a credit for any SDLT that you paid under earlier provisions, under early returns. So the SDLT for each return actually was not huge, but obviously there would be interest and there would potentially be penalties if those returns were now submitted. And the penalties, could be quite significant. Now, that is going to apply whether or not you sign the currently unsigned lease or you put in place a new lease, because if you sign the unsigned lease, basically it's treated as commencing at the beginning of the last point at which you've had a year's extension. So I think this lease expired in something like October 2017. And so the latest 12-month period would come to an end in October this year. And so if you sign the lease now, it will be treated as commencing in October. You'd work out the net present value, and you would get that same analysis if a previous lease was discarded and the new one draft now. So for the lease that was being held over, there is a compliance issue that needs to be addressed in relation to those. Now, after I'd given the advice, and when the client was obviously stopped panicking, actually, it turned out to be even more complicated, because actually that first property was 2 properties that had been bought at separate times, and there were 2 leases, and one of those leases has actually been in place since before December 2003. Now, the reason that December 2003 is relevant is that 1st of December 2003 is the date that stamp duty land tax was introduced. So actually, the pre-SDLT lease, the one that had been in place since before December 2003, these holdover relief provisions don't apply. So actually, we're back to there being 3 leases. 2 out of the 3 of them, actually, the best thing to do is to start now. The other one, there will be holdover. There will be less SDLT to pay, but there will still be penalties on the fact that there has been a failure. So quite a complicated case, but hopefully quite interesting. Okay, question come in. And this is going back to the question about dilapidations. Does a tenant get revenue relief on making a provision towards future anticipated expenditure? For example, when a dilapidations cost report is produced. Presumably no relief on capital allowances at that stage, as the expenditure has not been properly incurred at the date of the provision. Actually, it is very, very rare, if not almost impossible, to get tax relief for a dilapidations provision, because tax follows accounting. Accounting in terms of whether or not you can get tax relief on a provision covers FRS 12. And my understanding, even though I'm not an accountant, is that FRS 12 would never apply to something like a dilapidations report cost. So you can't actually get a deduction for anticipated cost of repairs in answer to your question, because tax follows accountancy in that situation. Okay, right, just very quickly, let's talk about repairs versus capital. And then we're going to look at some capital gains issues to finish off the session this morning. look in a little bit more detail. Excuse me. It's that time of the year when we're all veering on colds. So everybody knows, I think, or hopefully everybody knows, that you do not get an immediate deduction for capital expenditure unless it is expenditure on which capital allowances is due, which in relation to buildings can be quite problematic. There is no definition of capital other than the slightly unhelpful definition that it's anything that's not revenue, but then revenue expenditure is not defined anyway. And as in so many cases or so many situations, our view is really largely governed by what is in case law. There's a case that's often quoted, particularly by the Revenue, called Atherton v British Insulated and Helsby Cables, which says that capital expenditure is an advantage for the enduring benefit of the trade, but I've never really thought that that was very helpful. And it was to do with the cost of setting up a pension fund. You know, again, that yeah, it was unhelpful. But I suppose in relation to property, let's have a think about the sort of area where you are probably going to have you know, issues with capital revenue, where you have repairs and refurbishments. So actually we're going to have the next poll here, if we can do that. So how would you deal with refurbishment type scenarios? Would you get a specialist in? Do you assume all costs are going to be repairs? Hope that you've got enough information to decide what's revenue and what's capital, or ask the client to undertake a review, or indeed something else. And again, if you want to make any comments in either the chat box or the Q&A, then please feel free to do so. Okay, so pretty conduct a full analysis, hoping that you've got enough information. Get a specialist to do a full capital allowances review. Yeah, I mean, those are the two that I would have expected. Very broadly, what you've got to do is work out whether the expenditure is capital. Think about whether capital allowances would be available. Obviously, capital expenditure where no capital allowances are available is not very helpful, because you're not going to get any relief until the property is sold. And often you will have, it is difficult to get sufficient information to make an informed decision. Quite useful in terms of you know, the project, if you can get involved from the start. And somebody's made the comment, which I think is absolutely right, is the client needs to be convinced the fee for the undertaking of the capital allowances report is money well spent. Otherwise, in the absence of information, these costs would be shown as ineligible in the computation. Yeah, I think it's one of those things that I guess that is why an awful lot of people will say that they'll have a stab at doing it themselves. So normally there are two things which make something capital. The first is where you are replacing an entirety. So that's where you have a completely new asset. And in the context of something like commercial property, it is going to be very unlikely that you are going to see replacement of an entirety unless you actually knock down a building and build an entirely separate building there. And then I hope that everybody would, accept that was going to be capital expenditure rather than revenue. And don't forget that, the entirety is the building. So, you can have fairly large works which are replacement of an entire, not replacement of an entirety, and therefore potentially are repairs. If you've got a big warehouse and you replace the roof, it is the warehouse that is the entirety. And even though that roof might cost you many, many pennies, there is a chance that it could be a repair. But what you then have to consider is whether there is an improvement. Improvement is a bit of a difficult word, really, because if you've got a building that's got a roof that's leaking and you replace that roof, then you have improved the building as a whole, but it might not be capital expenditure. I suppose what I like to think is that has the work made the building different or better? I mean, different is probably, again the more appropriate word to use, because if you had a shop and you built a wall down the middle of the shop to divide it into two separate units, in absolute terms, that might not be an improvement, but it's still capital expenditure because what is there in terms of the fabric of the property is different afterwards. So, again, it's not something that is always very straightforward. I think there are nuances to this which can be quite difficult sometimes to explain to clients. In relation to the sort of the general points that we're looking at. Gosh, I've lost my train of thoughts because there was a question came in that I was just looking at. So there are nuances involved in this because if you are replacing something that is very old, for example, what you put in may well be better, but that it might be better simply because it is not possible to put in something that was the same quality as what was there before because of changes in technology. And, the example that I always give, although I know that we're talking about commercial rather than residential property, but, if you replace your central heating boiler and that boiler has been in the property for 10, 20 years, you might be replacing it notionally like for like, but it will still be a much better boiler. But that could still be a repair. So, that is not in itself necessarily going to be, a problem. But, again, it's just taking a view on it. I think the other area where we do get problems, and in fact, I've had a conversation with with sort of somebody this week about some repair expenditure, is that if you are doing a big refurbishment, and in fact, in the case that I'm thinking about, they were actually converted. It wasn't really a refurbishment, it was a conversion. They were converting it from commercial to residential. And effectively, one of the things that the client had questioned was the fact that the accountant treated replacement of the windows within the building as being capital rather than revenue. And he'd said, oh, the revenue manuals say that you can have replacement of windows, and I'll come on to that point in a minute. The problem is that the revenue will look at the overall project being done. And so certain of the expenditure, which might be repairs if you were doing it, just as an isolated thing, might be repairs, will be capital because it's part of a bigger overall scheme of work. So you do have to be slightly careful that you are not. I mean, you can analyze things down, but you've got to be a little bit careful if you are overall improving something. that you do actually cover, you do cover everything. So it is not entirely straightforward. So a couple of points have come in. What are the rules for replacement of domestic items relief for property investment companies? My understanding is that things like replacement fridge freezers are only allowed within a property owned by an individual and not a company. What's the treatment here, please? So we disallow things like beds, freezers, fridges, triple glazed windows, and so on. Yes, I mean, it is one of those things that often does get overlooked. And that is that, the replacement of domestic allowances relief is in the sort of income taxes legislation. But interestingly, it does say you can get domestic items relief where conditions A to D are met. Condition A is that a person carries on a property business in relation to land, which consists of or includes a dwelling house. Now, that is person and not individual. So let me just have a look and see. I must admit, I can't remember what the particular provisions are, whether it is just in individuals or whether it is companies. Yeah, no, there are corresponding provisions for corporation tax purposes. So, yeah, you can get it for a company. You can get the normal replacement of domestic items relief on any of the kind of things that you would get for normal purposes as well. So it isn't just individuals, it is companies as well. Which, as I say, is quite interesting because I had to check that point. I couldn't remember off the top of my head which one it was. So yes, it is. Now, obviously, triple glazed windows. The reason that that's been brought up and is that HMRC accept that double glazed replacing single glazed is not an improvement. What they do seem to be slightly hazy about is triple glazed versus double or single glazed. Effectively, I think you might still have an argument that triple glazed is not an upgrade. But again, the revenue might argue that that's not standardized for commercial buildings. I think I might be kind of willing to take a punt on that one, really. Because I think these days, triple glazed are very much becoming the standard. So yeah, you can get that, which, as I say, is an interesting point. And when I had to check, I couldn't remember off the top of my head what the right answer was. So yeah, it is available for property investment companies. I have had another question I'll answer in a minute. One of the things that is often a question that gets asked, I think, is to do with assets in defective condition. So you buy an asset and then you do the work on it. Is it a repair or is it capital? We've had a number of cases. We've had a couple of cases which people often study when they're doing their training as to whether or not you can get a deduction for repairs. I mean, obviously, we are going back to general principles. So if you are making an improvement, then it will be disallowed because it's going to be capital anyway. If the work that you are doing would have been repair work, if you had been doing it, having owned the property since the ARC sailed, then the other two things you've got to think about is could the asset have been used without the work being done? Although, again, I mean, you might argue that, if it couldn't be used without the work being done, it's probably almost inevitably going to be improvement. And was the purchase price suppressed due to the condition? If the asset couldn't really be used and the purchase price was less, then even if it is repair type expenditure, it is probably going to be disallowed as capital. Okay, I have an example where the dilapidations provision, this goes back to the dilapidations provision I was talking about, provisions don't normally get allowed. Under GAAP, there was a detailed calculation showing a revenue capital split. In fact, the clients did not want to book it, but the auditors pushed the point and it was material. We follow accounting. So if the auditors were happy that, do auditors check? Anyway, as long as they are happy that it meets accounting and you can put it through the accounts on that basis, then you would get a deduction for tax purposes. Because for those kind of things, tax follows accounting. So that is the way that it goes. Okay, right. Capital gains tax. I mean, I think capital gains tax is deceptively simple. You sell a property, you take the sale price, you deduct your allowable costs, and you then have a profit, and that's subject to tax. But obviously, I suppose the first elephant in the room we have to think about is there any doubt as to whether or not what you have got is a capital gain versus trading income? And that then begs the $64 million question: what is the difference between a property investor and a property trader? The investor being the one who is holding it as a capital asset, and the trader being the one that is holding it as a stock. And if you wanted to look at investor versus trader, we would typically be looking at the badges of trade, although in all honesty, I have to say that I feel that the thing that is very important with properties is what was your initial intention. The difficulty again there is that for somebody who is regularly dealing in property, probably their intention is to make as much money as they possibly can. So effectively, you know, this client I've got, he's a property developer. I mean, he buys property thinking, oh, I can make money out of this. And he will then decide whether he is going to develop it and sell it, or develop it and rent it out, or hang on to it and, you know, just let it slowly appreciate in value. So he, you know, he may not be buying it, you know, in some situations. And somebody said, you know, don't the transactions in land rules apply here? And I'll touch on those in a moment, actually. HMRC may not challenge investment versus trading unless they can see that there is a big tax difference. To be honest with you, the obvious situation where there is a big tax difference is where you've got an individual with residential property who's claiming private residence relief. And we've had a couple of cases recently where somebody's claiming private residence relief and the revenue have tried to attack it, arguing that it's trading, so that the private residence relief becomes irrelevant. And in both of the cases that I can think of that we've had recently, the revenue have effectively lost the trading point. And in fact, in both of them, I think they've lost the private residence relief point as well, but I can't remember what the decision in the first one was. Now, clearly, the only other major difference that you might have between property investment and property trading is if you're a property developer, so it's income tax, you have the ability to deduct your interest payments. If it's a capital gain, you don't get a deduction for any of your financing costs. Obviously, for an individual, again, capital gains may well be cheaper, although if you can deduct financing costs, it may not be. For a company, there's probably not a great deal of difference because the tax rate is going to be the same. So, I mean, this slide really just summarises the difference between the two, and probably not something that we need to think about too much. So transactions in land provisions is an interesting one, because if you look at the transaction in land provisions is an anti-avoidance provision designed really to, or when it was changed in 2016, which was the last time it was updated, really designed to tax people who were developing land within the UK who did not otherwise have an exposure to UK tax. Now, that at that point largely meant non-residents, although of course non-residents came into tax in 2015 on residential property and then 2019 on commercial property. But there was also, the reason it was introduced was because of the definition of a permanent establishment not always covering construction sites. It's a very geeky bit of tax knowledge, that. The revenue use manuals are pretty clear that the transaction in land provisions would not apply in a situation where the badges of trading might otherwise apply. And actually the transaction in land rules apply in a very, very narrow set of situations. Probably the most obvious situation where transaction in land provisions might kick in, and where you would have an income tax charge rather than a capital gains tax charge, is where you've got slice of the action type contracts. So where somebody's selling land perhaps to a developer, but part of what they're going to get is going to be a cut of any subsequent profit. So again, it's a difficult one. So assuming it's a capital gain, what you do is you apply your basic computation and then consider whether there is any reliefs that are available. And so in terms of the calculation, you have got your disposal proceeds, allowable costs of acquisition, allowable costs of sale, and then any enhancement costs. And I have to say that I do get asked quite a lot of questions on enhancement costs. Obviously, you need to make sure if you're talking about, residential property, or property, make sure you haven't claimed the costs as repairs. It has to be reflected in the nature of the asset at the date of disposal, and also can cover things like the cost of establishing, preserving or defending title. Where assets have merged, you can take joint costs. I'm just going to ask the next poll now. I mean, this is not directly relating to property, but I do think it is quite an interesting one, because it makes you think about it. So individual owes money to a company, they're 100% shareholder, they write off the debt and then sell the shares. Is that enhancement expenditure by the individual in relation to the shares? So again, it's quite difficult to think of an equivalent provision, but this just, I think, is a case which shows that it is not all entire. It's not entirely straightforward. No, the majority of people say, and I think that's absolutely right. The point is that the writing off of the asset that's being sold in that scenario is the shares, and that does not alter the nature of the shares. The write-off of the debt may change the value, but it does not alter it does not alter the nature of the asset, and therefore you wouldn't get an allowable deduction for that. And again, I think that's quite a straightforward one, but It is quite important. Sometimes you do get questions about enhancement costs, where you do have to be careful as to whether or not actually that is going to be allowable. Okay, question is coming, quite a long question. I have a friend who's some prime farmland in Tunbridge Wells, used as farming, freehold, land and buildings, passed through the generations, used for farming, worth lots and lots of money. If a part disposal of the land for the intention of developing by the developer subject to planning permission, and the current owner receives a slice of the action, would this part disposal be exempt by way of the BPR farming provisions, or is this a separate transaction because it's sold to a developer? I'm not quite sure what you mean by exempt by way of the BPR farming provisions. Are you talking actually about BADR? Or is that a separate transaction because it's sold to, BADR, because it's sold to the developer? Really interesting question, because I suppose it depends on I know depends is such a cop out and an answer to such a question. If there is some uncertainty about what is going to be received, then there is certainly an argument that it is going to be income rather than capital under the transaction in land provisions. But there are quite a few get out of jail free cards in the transaction in land provisions. And it would be interesting to see whether or not there would be any possibility of actually formulating a contract which would get round that point. Now, obviously, as we're going to see in a moment, one of the issues that you have with getting BADR on the farm is going to be whether or not you are disposing of all or part of a business. And if you're just disposing of a bit of land, you may well struggle to get BADR on that in the first place, only part of it. But I'll come back to that point in a minute. But I mean, obviously, there is still a big difference, even if you're paying 24%, capital gains because you don't get BADR. It might well be that you are going to that you are still going to save money because it might otherwise be at 45%. Business still continues, but excess land and to cash in on the future development value. Let me come back to that when I get to BADR, and I'll just discuss that a bit further. Don't forget, market value can be imposed either when it is a connected party transaction or where something is a bargain otherwise than at arm's length. And again, that is, the first one people often overlook. But the thing about connected party transactions is that you automatically impose market value if the deal is done at another price, whereas with the first one, the revenue first would have to show that it's not a bargain at arm's length. And it's important to note that just because you are prepared to sell at a reduced price doesn't necessarily mean that that's a bargain at arm's length. Sorry, not a bargain at arm's length, because it might just be that you need to sell it very quickly, or you've just done a very bad deal because it's something you didn't know about. Don't forget, with connected parties, if you're transferring between connected parties, if you make a loss, those losses are clogged, which means that they can effectively only be offset against transactions with the same party. It's not just on other connected party transactions, it is actually the same party. Allowable costs, again, most people will be familiar with this. Incidental costs of acquisition or disposal, including professional services, advisors, costs of transfer includes SDLT, costs of advertising, the seller or buyer, costs of getting valuations for CGT purposes, not normally something that we see an issue with, but occasionally we can get a dispute. I suppose with commercial property, there may well be more issues with costs in terms of things like, getting planning permission, building regs approval, environmental assessments. They may or may not be in connection with acquisition or disposal. They may or may not be enhancement expenditure. Again, I have seen cases in the past where there have been question marks over whether or not actually those costs are going to be allowable. Okay, so let's just talk about BADR. This, I think, then brings us back to the issue that we were talking about. And this is really, now we've veered round a little bit more towards a situation where actually we're talking about people who are holding property as part of their wider business interests, as opposed to just purely being an investor. If you are talking about property held as part of an unincorporated business, you've got two options. The first is that you are selling all or part of that business that has been run for 2 years up to the date of disposal, or you've got the alternative that you've ceased the business and the individual ran that business in the 2 years up to the date of cessation. And that could be either as an individual or it could be as a partner. And post cessation, you've got to sell the assets within 3 years, although there is no restriction on assets during that period. But that 3 years is an absolute hard deadline. You've got to work out when you ceased. You've got 3 years from that date, and there is no extension. There can, in certain situations, be a question mark over when the business has ceased, or indeed whether it has ceased at all. So going back to the question where you've got farmland and they're going to do a part disposal of part of the land, you have got to demonstrate that you are selling all or part of the business. And there is a lot of case law, which, I say a lot, and there are a handful of cases, because this was relevant when we had retirement relief. And for retirement relief, you had to sell all or part of your business. And again, farms were the kind of cases that we saw going through the courts. And the courts were pretty strict in saying that sale of land in isolation is not sale of part of the business. So in your client's case, if the business is continuing and there's been no material change in the business by the sale of this excess land, then that is not likely to get BADR. Even if the land is surplus to requirements, I know you've just put that in the notes, I think you might well, if there is no material change in the business, that is not going to be disposal of part of a business. And the thing is if there's no material change in the business, it's just smaller, that's also not sale of part of the business. So I don't think in that situation you're going to get BADR on it. So you've got two issues there. Is there any way that you can get BADR? You would hopefully get capital gains on some of it. You say, where's the incentive to sell? Well, the incentive to sell may be that you're just going to get a huge amount of money for it. It depends. It depends exactly what the deal is, but it might mean because you've got to pay more tax on it that you're going to want a bigger figure for it. Okay, so the land is surplus to requirements, but that doesn't mean that you are going to get BADR on selling it. So you've got two issues. The first is I don't think that you're going to get BADR on it, although, as I said, the every little helps, but BADR in absolute terms is not as generous now as it was in the past. But the second bit is any of it actually going to be subject to income tax under the transactions in land provisions? And again, that one is more problematic because it may very much depend on the way that the that the deal is structured. And it may well be, of course, that if this is being bought by a large house builder or something similar, they may well have schemes. They may well have ideas about how you can actually do that, structure it so that you reduce the risk that the revenue can challenge it as income. So just an example of post cessation, how this works. Individual has a pub business, has ceased trading, has not economically viable anymore. Nothing happens with the premises. He starts to get planning permission to convert it into residential flats. Not happening very quickly, approaching the 3-year period. Have you actually got any options as to how to crystallise the gain in order to claim BADR? Well, you could transfer it to a limited company, although there would be stamp duty implications in doing that. The other thing you could do would be to appropriate it to trading stock. So start a property development business, transfer it to trading stock, and that would crystallise the gain. In both of those cases, though, you are, of course, going to be crystallising a gain at a point where you may not actually have the money to pay the tax. So given how this is actually an example from when BADR was entrepreneurs relief and it was 10% and you got £10 million. And actually the advantage of actually what we did was an appropriation. The advantage in doing that was significant. And so it was worthwhile doing it. So going back to all or part of the business, again, we've discussed that, I think, already. It's a really difficult one, particularly where you've got unincorporated businesses. That is something that I had a case a few years ago where we had a farm where they were effectively, there was a partnership, and it was a farming partnership which was effectively the second or third generation of the original owners. So there were about 10 partners and they didn't get on. And effectively, we had a situation where they were selling half of the farm. And again, this was at a time when BADR was £10 million. They were selling half of the farm. And then there was a chance that later on they were going to sell the other half of the farm. And basically I said, well, you need to cease trading. You need to cease trading so that you get BADR on that half of the farm that you're selling. And 2 or 3 of the partners weren't that bothered in doing that because they'd only recently inherited the land and they'd obviously put a hugely high value on the land because they got full APR on it at that point. So we had so many arguments about whether or not it was worthwhile ceasing the trade. In the end, the trade did cease, so that they could get the BADR, but we were talking about millions there, a huge amount. So associated disposals is where you have an asset that is held outside of the business, and either outside a company or outside a partnership. And what you do is you sell it at the same time as you make a material disposal of the associated business. So you have to be selling a bit of your partnership or a bit of the shares in the company. And there are various provisions that I'm not going to go through because I'm already running out of time. The slight problem that you have with associated disposals is that the gain can be restricted. The first is if the asset is only partly used for business. The second is if the asset has not been used throughout the period of ownership. Or the third one is if rent has been paid. And the rent bit is just a bit complicated, although as we get further and further past 2008, it's less so. You only consider if rent is paid after the 6th of April 2008. And if you've paid some rent, but it's not market rent, it's prorated. So it's not always a very straightforward calculation, I have to say. So here we have a question. Sajid has a partnership which he operates as a restaurant. He owns the business premises outside the partnership. There are 2 floors above the restaurant, one which is occasionally used for storage, one which has a flat which is rented out to the friend of his daughter. The floor area of each part is the same. How would you apportion the gain? How would you treat the floor used for storage? And does that qualify for BADR? I think I would be arguing that 2/3 of the gain qualifies for BADR and 1/3 doesn't. If one of the floors, 33% restriction, I think that's how I would be dealing with that. So yeah, I think that's how you would do it. I've just done one where we've had rent paid to a partnership, and we've just had to do a really, really detailed analysis of what the market rent is, whether the market rent was being paid, because there was a notional amount being paid, and we've done, gosh, that was a big calculation. It came out a bit like an exam question. So, you know, again, one thing that it's quite important to remember is that you don't have to do an apportionment where the asset is actually held within the business. So for sole traders, that would be any property. So as long as the building is primarily used for the business, then you can actually get BADR in the whole property. So if you've got, say, a shop used for the purposes of a business and a flat above that, which is rented out, as long as the shop represents more than 50% of the whole property, then you would get BADR on the whole property if you're a sole trader, or if that is an asset of the partnership, assuming that the partnership has ceased trading. In both situations, actually, if the sole trader has ceased trading. If the flat is worth more than half of the property, then you get no BADR in any of it, because it's not primarily a business asset. And that's one, I think, where apportionment becomes quite an interesting one. My ex-husband has got a shop with a flat over it, and he trades from the shop, and the flat is above it. Now, it's a bit of a strange configuration, and probably the flat is slightly smaller than the shop in terms of floor area, though it's very, very marginal. I think almost certainly the flat is worth more than the shop. But if he ever does sell it, I would imagine he will claim BADR on it, although that will be down to me rather than him, since I do his books. So again, you just have to see. So other reliefs that you get for businesses: rollover relief, where you have an asset selling, a trader selling an asset and buying a new one, where both of them are used for the purposes of the trade. This can also, rollover relief can also apply if you've actually got an individual holding property outside of a trading company that's used for the purposes of that trading company, as long as the new property that they hold is also going to be used for the trading company. So you have a specific period, 12 months before, 3 years after, to invest. And somebody says, is this ever used that much in practice? I think I've had one client use it in 12 years. Well, it's an interesting point, actually, because I think if you qualify for BADR, when BADR was at a rate of 10%, I think you're right that rollover relief wasn't used very often. But I would have to say I've had more queries on rollover relief in recent years than I have in a long time. So I do think it's one of those things that might well come back into people thinking about it. So, you know, again, I do think it's something that might come back in. It must be a qualifying asset, but land and buildings are qualifying assets. If you are going to reinvest the money, you can defer the tax pending reinvestment, and you can get partial rollover relief if not all of the proceeds are reinvested. Couple of points to note. You have, I've said reinvestment's got to be within a specific period, 12 months before 3 years afterwards. That period can be extended. And I think the longest period that I've ever seen rollover relief extended for was 20 years. Very strange circumstances. Somebody sold land to the Department of Transport for part of the M62, and it took them 20 years to negotiate how much money they were going to get. It was under compulsory purchase order, how much money they were going to get from the Department of Transport. And they didn't get any money for 20 years, which to me is horrendous. So they couldn't buy any more land until they'd actually they'd got the money, and the revenue accepted the rollover relief. That was quite an interesting case, though, because at one point, the chap who owned the land, he was a sole trader farmer. The chap that owned the land was really, really poorly. And if he hadn't been able to reinvest it before he died, the game would have come back into charge, and we'd have had 15 years worth of interest to pay on it. But we basically got the revenue to admit in that situation that if he had died, they wouldn't collect the tax, because the delay had been on the part of the government. Anyway, it was you know, disgraceful, as somebody has said, but it was an interesting case. The other thing is that you have got to have an asset that is being used for the purposes of the trade at the time that you sell it, and the new asset has got to be brought into use in the trade. Now, going back to the question earlier on about the farmland, where you're selling that for development, if that land is not currently used for the purposes of the farming trade, if it really is surplus to requirements and it is not being used, there is an interesting question as to whether you would get rollover relief on it. I mean, they might not be looking to roll over the game, but there is an interesting question as to whether they will get rollover relief on it, because if it's not actually being used in the trade, and this is one of the issues that you have with people who stop using land, particularly farming land, which they are thinking that they might then sell, because there could be an issue that they're not going to get rollover relief on it. So that is one thing. And the other thing is you have to bring the new land or the new building into use as soon as is practical afterwards. And if there is any delay, HMRC might again. So it's not used out of choice, and it still might be an issue that it's not being used. Anyway, you'd have to have a look at that. The example on the next slide is really just about the calculation, so I'm not going to go through that at the moment. As I say, I think the two things with rollover relief is the asset being used, is the new asset going to be used, possibility of extending the reinvestment period. Talking about the reinvestment period, I did have another case where somebody had actually sold their business premises to the London Olympic Authority when they were building the Olympic Park, and then sued them because they thought they'd sold it at undervalue. And that took a long time to be resolved, but that was a case where the revenue actually wouldn't allow an extension to the time limit for rollover relief, because basically they said it was a choice of the taxpayer. So that might be. The other one we see is holdover relief, where you are effectively transferring an asset to somebody else which has been used for the purposes of the business. There are two reliefs that you've got. The first is where we've got rollover relief. Of course, we've talked about already generally, but you've got to be careful, because if the gain that you roll over into, the asset that you roll over into is a depreciating asset, then effectively the gain is not deferred indefinitely. It's to the date of sale, or the date at which the asset ceases to be used for the business, or 10 years. You can reinvest into a wasting asset and then reinvest back into another asset. So that's sometimes something that you use. So for example, you could get a situation where you could get, you can't reinvest it into, freehold property. So you buy a lease to get the holdover relief. Although I say, again, that's not something that we see very often. So, it is something, as I say, that I don't think we see very often, but could potentially come back in situations where people are not now going to get BADR. And yeah, I don't necessarily think that people see it very often. That point about the asset, the gain being deferred, it comes back into charge at a particular point. It is important to remember that that does actually only apply for depreciating assets. If you have an asset, if you buy freehold land, even if you stop using it for the purposes of your trade, then actually the gain doesn't come back into charge if it's not a depreciating asset. And that's where furnished holiday let property was always very useful, because you could effectively roll over gains into furnished holiday let property, and then you could then stop using it for FHL. You could start using it for long-term rental, and you didn't get the rollover relief coming back into charge. I did have a few clients last year, before furnished holiday let treatment was removed, invest into furnished holiday let property and rollover gains with the intention of doing that. So it is possibly something that you might see. And then the last couple of slides, I think, is just going back and talking about the bits I've already covered, really. So we have just got a couple of minutes left. I suppose before I say farewell, thank you for the questions that have been answered today. I hope that you have found these interesting. Any thoughts briefly on the tax changes by Miss Reeves? The headliners: change in income tax, 2 up, 2 down, pension changes. I'm always hopeless at this, to be honest with you. My biggest concern, in all honesty, is that we have a lot of very little changes. In many ways, and even though this is going to be a controversial thing to say, in many ways, I'd rather they put the rate of income tax up, get all of the tax they need in one hit, rather than having loads of changes to pensions, loads of changes to national insurance, loads of changes to employment taxes, loads of changes to lots of different things. Because the tax system is so complicated. We do not need more complication. And so if I was the Chancellor, I would put 2p on income tax and put the personal allowance up, so that basically they could say, well, I'm sorry, we've had to put tax up, but we've protected the lowest paid. And that, I think, is what I would do. But I'm very glad I'm not the Chancellor, because I wouldn't want to be. But I think that's the thing that really concerns me, is we're going to get a huge number of changes, and then we're just all going to be reeling, because we're going to get clients asking us questions about it. So that would be my answer, really, which is not really an answer. But anyway, thank you so much. And thank you again for all those people who have put questions in today. It's been great. It's always really good to have that participation. And I will see you again next year. Thank you and goodbye.